If you own a home with some equity, one of the smarter ways you can weather the COVID-19 storm and save on borrowing costs is by utilizing home equity line of credit, HELOC for short. In the regular times, HELOC has typical dangers associated with any type of debt. But when you take COVID-19, potentially falling real estate prices, and banks needed to make up revenue for the loss in commercial real estate, taking a HELOC during COVID-19 is both extremely difficult and has extra dangers associated with it. So this video is about HELOC during the COVID-19. Let's quickly go over the basics of the HELOC loans. So equity in your home is how much of the home you own. You can increase it by either paying down your mortgage or if the value of the real estate keeps going up, which is what was happening in the good old days like 2 months ago. So HELOC is when you take revolving credit against that equity in the house. And by revolving, it means you don't have to take all of them out at once. You can take as little or as much as you want, and you can pay down when it's comfortable for you. This is different from home equity loan, where you have to take the whole amount and make fixed payments. So HELOC is more similar to credit cards, except that the interest rate you're paying is way lower because banks are not incurring as much risks. On top of lower interest rate, one of the benefits of HELOCs is that they allow you to tap into your home equity without having to sell your house and incur capital gains tax. And this low interest rate is usually timed to the prime rate or overnight rate, where a bank adds their own markup called marginal rate. So when we want to evaluate HELOCs, there are a few things we gotta evaluate and keep in mind. Number one is what's going on with prime and marginal rates. At what direction real estate prices are heading? Are they going up? Maybe they're going down, or they're stable. And what's happening with people's ability to pay back the loans, because that's how bank evaluates the risk. What are the typical dangers with HELOCs? In a regular world, when real estate prices are stable or going up with the normal economy, HELOCs are a great product for both banks, who don't have a lot of risks because you have equity as collateral, and consumers because you have this flexible credit with low APR. And the only dangers are usually associated with any debt product. I think number one is psychological, because some people look at HELOCs as the money they have, even though it's borrowed money. And I've seen situations where people took HELOC, paid down their credit cards, and instead of changing their spending habits, they just kept putting balance on the credit card, relying on a HELOC to pay them back. And number two, it's tied to prime rate. So if that goes up, your borrowing cost is going to go up. So sometimes it's hard to accurately predict your interest costs. Now let's move to COVID-19 world. What is happening with prime rate? I think everybody knows it's the overnight rate is negative in US. It's almost zero in Canada, so you would think there is no concerns there. However, while banks were super quick to drop their savings rate, I haven't really seen a drop in interest rate, and what banks are simply doing is increasing their marginal rate. And depending on how banks assess the risk, this rate can be increased significantly, again making those borrowing costs unpredictable and volatile. Next thing I want to look at is how busy the banks are. With COVID-19 and loss of jobs, a lot of people are applying for different loan products. On top of that, a lot of government aid comes in the form of loans, which further puts the strain onto the bank's capacity to process loans. I had to call my bank the other day, and it took me 2.5 hours to get somebody on the phone. So banks are extremely busy. Typical processing time used to be 30 days, but right now the window that banks give is 90 days. And remember, you'd have to have an appraiser come to your home to evaluate its value. And depending on where you live in the quarantine rules, that might simply be impossible at the moment. That is why, to reduce the strain on their capacity, some banks completely stop accepting new HELOC applications. JP Morgan and Chase was the first bank to do it. Wells Fargo firstly hired their borrowing standards, but now they also said they're not gonna accept new applications. Borrowing standards leads me to another issue to consider. Before the crisis, you would have to have debt to income ratio of less than 45%. and credit score of 620. Before Wells Fargo stopped accepting new applications, they hired the credit score requirement to 720. So you need to understand that if you are to apply to an institution that still accepts new applications, you'd have to have extremely great credit profile. The next issue we gotta look at is what's going on with real estate prices, because remember, the equity is tied directly to the value of the house. With so many people out of job, with uncertain economy, there is a possibility that the value of real estate is going to crash, especially towards the second part of the year, because companies are going to release their Q2 earnings, and that might cause stock market to crash, and there is a closed loop system that will negatively impact real estate prices. If real estate prices fall significantly, banks might completely reevaluate the whole HELOC because the value is just not going to be there. Which brings me to the worst case scenario, and that's HELOC freezes. Now, that's not happening right now, but it did happen after 2008 crisis. Banks just froze the HELOCs, and there is a few ways they can do it. So one option is they can prevent you from withdrawing more money, effectively making it a closed-ended loan, because once you pay it off, it's gone. Number two is they can call a portion of the home equity almost immediately, meaning you have to pay it back, and that brings the ratios of borrowing that they use up to the current standards. And the third option, the worst case scenario option, is they call the whole loan almost immediately. And if at that time you can't pay it back and you use your home as a collateral, you're in a really dangerous situation of losing your house. So if you have a great credit profile and think you can qualify for a HELOC during this environment and can find financial institution that will accept new applications, here are a few tips from us. Number one, do it as fast as possible, because it's going to take forever for your application to get processed. Two is, if you do get approved for the HELOC, don't take more than 30 to 35% of your available credit, because your utilization score, which is a ratio between your available credit to what you actually took, if you go way higher on that, this is going to negatively impact your credit score. And if the real estate prices are going to fall and the value in your house is going to decrease and banks call the portion of the loan, you're not in as risky situation where you only borrow 30% of losing your house. And the last piece of advice, remember, if you have a mortgage on your house, that's another thing that's borrowed against the house. So we highly suggest adding your mortgage to your HELOC and making sure you're not borrowing more than 70% combined of the home value. And that's because if the real estate prices do fall, again, you're reducing the risk of you losing the house. In summary, it is extremely hard to qualify for HELOC. It's going to take a long time, and even if you get it, please be careful with it. Thank you for watching all the way till the end. I hope you found some practical value in this video. If you did, please consider subscribing, pressing like, and sharing with your friends. And I hope you can continue building your wealth even during the COVID-19. Till the next time.